Well, it's time for our Spend with TMS segment, and at this point of time, I suppose all our viewers, and I say all because everybody has this love affair with this particular asset, will have cause to celebrate because the asset that we're talking about is gold. Prices are at a record high, and the last time I checked, if you'll go to sell your gold in Bombay, you're going to get a neat 42,000 rupees per 10 grams of gold, all else being equal, of course. So we've hit a record high on gold prices, and that's on account of several reasons. We've had this entire geopolitical issue that's becoming quite problematic. So a lot of investors are, rushing for safer havens like gold. So internationally, prices have soared to $1,600 per ounce, which is, by the way, the highest since 2011. Now, you may be wondering that why is Indian gold at a record high, whereas gold abroad is just at that 7-year high? Well, that's another reason. The rupee has depreciated significantly, which causes our own gold prices to go much higher in trade. And of course, not to mention another reason for safe haven buying is also because economic growth as well has slowed down a tad bit. So how can you ride this rally? How can you as well take advantage of this? What should you do with all the gold coins, bars that may be lying with you in your lockers at home? Let's understand that with Harshvardhan Roongta. Harsh, thank you so much for joining us on the Money Show. All of us have some or the other asset of gold lying with us, maybe on ourselves, maybe a few coins that we've got as gifts. The question is that if my jeweler is offering me 42,000 rupees for 10 grams, is it a good time to then just sort of liquidate my gold if I need money right now, as opposed to maybe liquidating my mutual funds or any other asset that I own?
See, I think any decision to reduce the allocation to any asset should be part of your. It should not be tactical, as in if a price of a certain thing is high, you sell. If the price is low, you buy. I think it needs to be something that you would have decided in advance, and I think gold as an asset class is like equity. I mean, it will be volatile. You will have years during which it will not do well. You will have years during which it will do spectacularly. As far as investment is concerned, I think very clearly, like equity, you should do it systematically. Like equity, you should have a certain percentage allocation. If because of the increase in valuation, it has gone above your asset allocation, then by every means sell it, right? And adjust it back into equity. For cash needs anyway, don't invest in gold. For cash needs, you should have your money in liquid funds or bank fixed deposits, or whatever consists of your liquid money, and I think you should borrow from there. I don't think the increase in valuation should be a trigger to sell investment gold. I think that is something I would advise all people to do.
Distinguish, Mr. Roongta, between what you mentioned as investment gold or gold for consumption, which, basically is in the form of jewelry. A lot of us get gold coins as well as gifts. And then, of course, you have, your gold ETFs and, e-golds or sovereign gold bond schemes. How do you distinguish between all of this?
So I think one easy way to distinguish is anything to which you have an emotional attachment. I mean,
Okay.
something that's been given to you on a ceremonial occasion, which you have some emotional attachment to. It reminds you of a certain event, or your jewelry. I mean, I think uh, don't treat it as an investment. Sure, it has a lot of value, but it's like your residential house that has a lot of value, but you can't sell and stay somewhere else or stay on rent unless and until it's an emergency. So I think treat that as a consumption asset. Anything else. So if a gold coin is in the form of a bar and it has no special significance to you, or if the gold coin itself has no special emotional significance to you, then it's an investment in physical gold, and which you should consider shifting to the financial gold. I think clearly, as far as investment gold is concerned, it should be in financial instruments that mimic gold, and whatever is your consumption gold, you can't wear e-gold around your neck or around your ear. So very clearly, that has to be in physical gold. Whatever is your consumption part of the gold, that's not an investment. Everything else, I think now physical investment in physical gold makes no sense. With the triumvirate of your gold monetization scheme, the sovereign gold bonds, and the gold funds, I think, or the ETFs, I think with all these three, four products, investment in physical gold doesn't make any sense.
So basically, for all the couples out there who've just got married in this wedding season, who've got gold coins from their relatives and friends, now is maybe a good time to sort of liquidate that bit and, try and recover maybe a per plate cost of their wedding, I suppose. Take advantage of this 42,000 for gold. Okay, so Mr. Roongta, also when I'm looking at my portfolio holistically, and when I say that, okay, I have allocated this much to gold, do I have to include the value of this heirloom jewelry or this, the jewelry that holds sentimental value when I say that, oh, okay, 20% of my investable surplus is in gold? Do I have to include, heirloom jewelry as well? Because we often say, that you should keep maybe 10%, in gold or 15% in gold. So how am I to consider what is my total amount in gold?
See, I think this is an age-old argument. The house that you stay in, should you include it in your asset allocation or not? And my view has been always clear that the house that you stay in should not be included. The same logic applies to what I would say is consumption gold, which is your family heirlooms, your family jewelry, which you are unlikely to sell. Okay, something that you are unlikely to sell or convert into any other asset class, that I don't think you should count in your asset allocation. Very clearly that should be part of your personal assets, not included in your asset allocation. The others, like you just mentioned, newly married couple with gold bars and gold coins that they might have received on marriage, please convert it into the gold monetization scheme. Instead of lying idle with you worrying about its safety, you will have an equivalent amount guaranteed from the government, and plus you will get interest on that. The interest is taxable, but net of tax also there is some interest on that. And then for that period, whatever capital gains occur, that capital gains is free. So I think it has several advantages over physical gold, as long as it is investment gold, as long as you don't mind giving the gold away and getting gold in return on maturity.
Okay, the gold monetization scheme indeed is a great way to sort of earn some money out of gold that's just lying idle in your bank lockers or in your own home locker. Okay, so now Mr. Roongta, I switched on the channel and I see, oh, gold prices are at 42,000, but I don't have any gold in my portfolio. So would you recommend that? And of course, only gold for investment, not consumption. So I'm talking about e-gold, gold ETF, sovereign gold bond scheme. By the way, the new tranche will open on the 13th of Jan. But if prices are already so high, we usually say buy low, sell high. Then would you still say that investors or prospective SGB investors should still buy gold?
So again, as I'm saying, any volatile asset class, never buy lump sum, never time the market, just buy through a SIP. So you could buy a gold fund through a SIP. Unfortunately, sovereign gold bonds are not available through a SIP medium. So because it's not assured when it will be available. So I think the best route to do that, if you're not talking of an investment beyond 10-20,000 rupees a month, the best, although it's not the most cost effective, but the best, because it is convenient, is a gold fund. Okay, it may have charges, it may not give you interest, but at least it allows you to accumulate gold. It may not have the tax advantages that a SGB has or a gold monetization scheme has, but it is convenient, I think. So that is extremely important. That is one way of taking exposure to gold. The other way of taking an exposure to gold is by investing in the multi-asset funds. Multi-asset funds are required to have minimum 10% to gold, 10% to debt, and 10% to equity. And I think that minimum 10% lends a certain, uh, self-balancing sort of environment to those funds. as long as you do it systematically. I think lump sum investments in a volatile asset is best avoided.
Okay. That's a very good, point of advice, and hence, even when it comes to equity markets, experts like Mr. Harshvardhan Roongta always recommend doing a SIP as opposed to just buying it in bulk. Thanks so much, Mr. Roongta, then for joining in. Well, folks, gold is at 42,000, and I think it's a great idea also to opt for the gold monetization scheme. Get your gold working for you, your asset working for you.